Hello fellow compounders, welcome back. If you've been following my channel, you know that there are passive investors and enterprising or active investors. Although most of you believe that you fall in one of those two camps, you most likely fall somewhere in between. You are a hybrid investor. This means that you invest in both individual stocks and bonds and in passive index funds. You know who you are. Even though you might think that you're a passive investor, you secretly have a hidden account on the side that holds your Apple or Tesla stock, or God forbid, Bitcoin. Or you might think that you're an enterprising investor even though you have a significant amount of money in index funds in your employer's 401k. In this video, we'll explore what is the best portfolio mix between active and passive positions. I'll also tell you what is my current mix and what I plan to do. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you are responsible for your own financial decisions. First, let's review both ends of the spectrum, passive and active investment portfolios. We'll use the analogy of a McDonald's Happy Meal and a gourmet meal. Passive investors invest in low-cost index ETFs or mutual funds. This passive portfolio is like a McDonald's Happy Meal, while active investors invest in individual stocks, bonds, and other investments. This active portfolio is like a gourmet meal. Both approaches have their unique characteristics, advantages, and challenges. I'll continue using the analogy to illustrate their similarities and differences. Let's evaluate 6 characteristics. Number 1, simplicity versus complexity. A McDonald's Happy Meal offers a straightforward, easy to understand, and convenient meal option. In contrast, a gourmet meal involves a variety of ingredients, cooking techniques, and flavors, resulting in a complex and nuanced dining experience. Similarly, a passive index ETF portfolio provides an accessible and easy to manage investment strategy, while an active individual stock and bond portfolio requires in-depth knowledge, analysis, and ongoing management. Number 2, customization. The levels of customization varies between the Happy Meal and the gourmet meal. The Happy Meal caters to a broad audience and customization is minimal, limited to the flavor of the drink and how much ketchup you put or don't put on the fries. The gourmet meal can be tailored to individual preferences. In investing, a simple passive ETF portfolio offers broad diversification and some sector allocation flexibility, while the active individual stock and bond portfolio enables greater customization based on an investor's specific goals. 3, cost effectiveness. A Happy Meal is known for its affordability, while a gourmet meal is typically more expensive. Similarly, index ETFs are known for their low expense ratios, tax efficiency, and minimal trading costs, making them a cost-effective investment option. In contrast, an active portfolio can be costly due to trading fees, higher management fees, and potential tax implications. Number 4, expertise. Preparing a Happy Meal requires a lot less culinary expertise compared to creating a gourmet meal, which demands a skilled chef with extensive knowledge and experience. In investing, a passive index portfolio can be more accessible to novice investors or those with limited financial knowledge. On the other hand, managing an active portfolio typically requires a deeper understanding of business, financial markets, investment analysis skills, and experience in selecting and managing investments. Number 5, time and effort. A Happy Meal offers convenience and a quick consumption, while a gourmet meal needs time and effort to prepare and enjoy. In investing, a passive portfolio requires a lot less ongoing research, analysis, and monitoring compared to an active portfolio, which demands a greater commitment. And number 6, potential return risk. Both Happy Meals and gourmet meals aim to provide satisfaction, albeit in different ways. In investing, a passive low-cost index portfolio provides consistent exposure to underlying assets and predictable performance relative to a benchmark. An active portfolio has a potential to outperform the passive investments if the investor is skilled, but on the other side, it also carries the risk of underperforming the benchmarks. So, are you a Happy Meal passive investor or a gourmet meal active investor? I bet most of you will be both. You might be eating a Happy Meal with caviar on the side or having duck l'orange with French fries. The question is, how much of the portfolio should be passive and how much should be active? I'll answer this right after we define our portfolio spectrum. The portfolio spectrum goes from passive to active. On one end, we have the 100% passive portfolio, and at the other end, we have the 100% active portfolio. In between, we have the hybrid portfolio. Let's label portfolios that are hybrid. The 50-50 portfolio is what I call the conflicted hybrid, because the investors are right in the middle and can't really decide in which camp they are. They invest half of their assets in index funds and half of the assets are actively invested. The portfolios that are more passive than active, that means a higher percent is index funds, we'll call the passive hybrid. And the ones that have more active positions than passive, we will call the active hybrid. Where should you be on the investment spectrum? It depends on 4 variables. 1, the size of your portfolio. 2, your investment expertise. 3, the time and effort you'd like to expend. And 4, your investment goals. Let's review each variable. 1, the size of the portfolio. If your portfolio is less than $100,000, you should be 100% passive. It really isn't worth investing your time and effort to manage an active portfolio if you have less than $100,000. You should be investing the time and effort in improving your personal skills so you can increase your earnings and be able to contribute more funds to your investment portfolio. Once you reach the $100,000 size, you may consider changing to a hybrid or an active portfolio depending on your investment expertise and the time and effort you're willing to expend. Number 2, time and effort. If you don't have time to learn how to invest, you should be 100% passive. Depending on how much time and effort you wish to expend, you may do anywhere from passive hybrid to active hybrid or even up to 100% active. Number 3, expertise. If you don't have any business or investment experience and are not willing to learn how to invest, you should be 100% passive. Buffett's portfolio or the Boglehead's 3-fund portfolio would work just fine for you. You can see more about it in this video. If you decided to go the active investment path, as you grow in expertise and understanding of business, you can add more active positions to your portfolio. Number 4, financial goals. If your primary goal is to achieve market returns and maintain a diversified portfolio with minimal effort, then you may opt for a higher allocation to the passive investments. If you're seeking to outperform the markets and are willing to do some effort, you may choose to allocate a larger portion of your portfolio to active investments. Here's where I am in the portfolio spectrum. I've been investing for over 30 years and I manage my own portfolio. I run an active hybrid portfolio with a 65-35 active passive mix. My active portfolio is concentrated in 20 stocks, even though I do own around 100, but 80% of the value are in those 20 stocks. And on the passive side is mostly low-cost index funds by Vanguard. As I near retirement, all my new contributions are going to be going to the passive side of the portfolio. And my portfolio will transition from being an active hybrid to a passive hybrid. My objective is to have a 25% active and 75% passive portfolio when I retire. As I grow older, my allocation will move more towards a 10% active and 90% passive. And finally, when my brain isn't working well anymore, I expect the portfolio to be 100% passive so it's easy for my family to manage. Here are some pearls of wisdom I've learned over the years about the portfolio mix. Number 1, a beginner should start with a 100% passive portfolio and automate the contributions. Number 2, only once you have $100,000, you may opt to add active positions to your portfolio. Number 3, it takes about a decade to know whether you are good at investing, at active investing, or if it's just luck. Number 4, understand yourself. Go active only if you're willing to put in the time and effort needed to gain the investment expertise. Number 5, once you retire, you should keep your portfolio upkeep down to the bare minimum and go out and enjoy your life. Your portfolio should be either a hybrid passive portfolio or even a 100% passive portfolio. One last piece of advice. If you made the decision to be a passive investor and have the itch of buying an individual stock without doing research, take the money that you would have invested in that stock and go to Vegas. You will enjoy your money more.